So a quick recap to what we did last week. We saw substance over form. We said that in accounting, transaction must be recorded at what? Their substance, but not the legal form. So we should know examples of transaction that have their legal form materially different from what? The substance. That's the economic what? Reality. The actual. I personally call it the content, the actual meaning of that transaction. Good. So we give example that leases, sometimes the office building, we don't have physical cash to acquire them. So what do? We can lease them or we can what? Rent it for long period. But we are not the legal owner of the building. So does it mean that we don't have the right to record it in our books? Once the economic benefits moving from the building to us, not the owner, moving towards us, then we have to record it. In accounting, the one that have the control or the one that control the asset have the accounting right to record it, not the legal right to. If you go to the law court, don't go and tell me that you are in the building, so the building is yours. So that's an accounting wise. So accounting right is different from what legal right. Our right exists in books. Using the IFRS, we are done. Uh-huh. So that is it. So that's lease. Now today we will look at one aspect of the substance over form. Anytime the examiner asks you substance over form, we are asking you indirectly faithful representation. Because we said that to report faithfully, transaction must be recorded at their what? Their substance, but not the form. Good. So how do you know that this transaction is what the form is different from what the substance? So we have some indication situations that may indicate that this transaction it may have a different status in terms of the legal and then the substance. It's very important. And that particular question, together with substance of a form, have dropped 3 times for ACC and ICE. I'm waiting for the fourth time at what? That's ACIB. Yes, and I know your examiner very well. I know him very well. If I've seen the question, he will come to your own. So don't worry. Good. Now, he also talks about sale and repurchase agreements. You will sell an item to someone and in agreement state that okay, after some period I'll buy it from you. So in reality, it's not a sale. Even though legally you may transfer your title deeds to the person for that 3 month period or for that period of sale, but in reality, it's not a sale. Good. Now, how will you test for substance over form? That's indication. Good. So the first one is when ownership of an asset is different from the control. So when control of assets different from what the ownership. That means one person own an asset, a different person is using that asset. There's an indication that substance may activate the form. Good. So anytime one person owns assets, ownership, and there are other person also control, different person control the asset or use the asset, it creates what? Substance over form. It may create substance over form. Uh-huh. That does not necessarily mean that any times like that there's substance over form. No, it indicates that there's an indication that substance over form may take place. That is it. Then the second point is that anytime where there's a sale of a transaction below the market price and it includes a lot of conditions. I am selling my car to you. Exactly 3 months, return the car and come for your money. But if the value of the car is, let's say, 70,000, I'm going to sell to you at 40,000, but I'll buy it from you at 70,000. Now, anytime there was a sale and that the price is not at fair value, the fair value of the vehicle is worth 70. But because I was in a cash trap, I asked you to submit what 40 for my car. Exactly 3 months. I'll buy from you at what 70 or even 75 cities. Now, anytime there's a sale and that sale is what is at below the fair value, the market price of the assets, and they are what subject to conditions, a lot of conditions, a lot of argument, a lot of clauses. I'm doing this exactly 3 months time. Let's change it. Then there's an indication that substance may what outweigh the form aggregated. And then the third one is that when you are selling between subsidiaries or related parties, when you are selling between related transaction between what related parties, know that when you sell something to your son, will you sell it at the same as market price or like at ordinary market? No, you won't do that. So in reality, it's not a sale. You transfer the thing. Exactly, it's a transfer, not a sale. Good. So that is it. So when there's a transaction, so these are three conditions or three circumstances that may indicate that what the substance version of the transaction is materially what different from what that of the economic reality or the form. So that's it. Now, today we are going to look at the elements of the financial statement. That's what we go through the last time, right? We ended the we ended the qualitative characteristics. That's the content number three. We ended the content number three. So today we are going to continue with the qualitative characteristics of financial statement. So we're looking at the elements of financial statement. All of this we are learning how to prepare financial statement. Though. In fact, this subject, everything about this financial statement preparation, everything about it. So that's why we started. One, what are the concepts behind it? We are learning the concept after there. We went through the principles, the underlying assumptions, and then last week we saw what the features that this financial statement must what possess. And today we are going to look at what the elements that must be presented. So aside this element, we can't present any other item again. So that is the element of what financial statement. So that's today's first topic of the day. Elements of what financial statement. So elements of financial statement. Elements of financial statement. Now, element of financial. Please, no shortcut in exams. When you see me doing this, no shortcuts. No shortcuts in exams. Mm. So, in fact, the element must be real. The financial statement must be real. So, there are real elements on the financial statement. What are they? In fact, let me write that acronym first. Is E, the E is square, A, then L. So, real. So that means if I take a complete set of financial statements, I have to see these items on the face. That makes it what? A complete financial statement. So every financial statement will contain what? One, revenue. So revenue. Two. So this is square. So first one is expenses or expense. Then equity, which at the lower level we can tell as what? Capital. Then assets. And what? Liabilities. Right. So now you should know the definition of this element, what they mean. So we are going to look at them on their face. So revenue, expenses, equity, assets, and liabilities. So now, the stubborn guy among them is this guy. So let me circle. But we like it. I'll tell you why I have assigned him as the what? The stubborn guy. So come from now revenue. When you talk about revenue, okay, good. I learned someone.
Hello.
So what is revenue? Revenue. Revenue is an income arising from where an ordinary course of business. So they are income arising from where ordinary course of business or arising from ordinary business activity. That is revenue. So what you have registered your business for is revenue. And when you sell any item that you have registered your business, that form the principal activity. So if you go to Abosokai, then their major revenue will come from what? They sell of the spare parts, right? Good. So if a trader at Abosokai go and buy and sell vehicle, is there revenue? If you buy and sell land, it's not a revenue. Why? Because it doesn't deal with what? Land. It deals with what? Spare parts, cars. That will be what? Revenue. Abigail. So revenue simple means income or money coming from where? Still of items that you deals in. Still of what? Items that you deals in. Abigail. So that is what? Revenue. So in the simplest definition, revenue is what? Still of what? Items in an annual course of what? Business. Like your normal trading. What we buy and sell. That's the revenue. So for instance, the estate developers, their major source of revenue is the sale of what? Lands and the building, right? Good. When they sell their cars or when they sell any item apart from the land and building, they will not classify it as what? As revenue. Why? Because they don't deal in such item. Now we get it. Bed banks normally sell some of your old unused vehicles. It is not revenue because you never say business to be selling vehicles. How we get so that's the core purpose. So that's revenue. That's great. Now you know this from the level one, and then sales, it can be credit or it's cash. Both of them. That's what we want here. What about expense? Expenses. Expenses. And now, when I define it, I will tell you the recognition criteria. In fact, there are condition. Condition must be there before you tell yourself that you've earned a revenue. Not that somebody call you, okay, hello, do you have goods there? Yes, I do. I want to buy 30,000 of them. Then I'll start recording revenue. Oh, I came to the shop. I picked that item. Oh, how much? 10,000 cities. Then you're recording revenue. No, there must be condition. So one, we are going to use one of the standards. That's IFRS 15. Talks about revenue. It gives us the condition that must be there before we can record revenue. It must be what? N. The performance obligation must be satisfied. You have to actually sell the goods to the person before you can record revenue. Ownership, that's sale of goods act, those who term law, sale of goods act. Property in goods must be passed before we can make a sale. It doesn't matter whether we are keeping it. Maybe that customer said that we should keep it. It's not for us. We are just holding on for him. We've taken our money. We've passed on the title deeds, but we still have it in our shop. It's still revenue. So it does not mean goods that we've pass it away. In fact, you can even sell goods, but they are not revenue, like agent sales, or even like warehouse or the sales outlets. Maybe distribution centers. You distribute goods to your various wholesale joints. That does not mean that you made a sale. So until these goods are passed on to a customer, that's where you can record what? Revenue. How do you get it? Great. So revenue must be recognized as and when they end. That's actual concept. When they occur. And it will occur if the property has been passed. How do you get it? Good. Now the expenses. Expenses means decrease in the asset in the form of what? Outflow. Decrease in what? In asset in the form of what? Outflow. That's expenses. Just before I explain equity, I will start with capital first. What is capital? Capital. Any idea? Some people have been saying capital, equity, capital. hmm There's a general definition going around. When you ask them, they'll tell you that it's the money that you use to start a business, right? As soon as you bring that definition on board, I'll just ring two items for you. I ring money and start. Capital refers to resources supplied to the entity by its owners. How do you get it? So any resources that the owner supply to the entity must be called capital. And then it doesn't matter the stage, whether at the start, at the end, but sometimes you have to even supply capital before you shut down your business. Assuming that you own a lot and you want to go and close or go and then wind up your business at the registrar general, do you think they will allow you to shut down easily like that? Maybe ask to pay all your suppliers before you shut down, especially if that business is what is legally not separated from the owners for sole traders and partnership. If like men's goods, if number one happen to register the business as a sole trader or partnership, by now you won't sleep. Oh, you won't sleep. Exactly. It's because you registered as a company. Good. So that is so capital simple means resources, not necessarily money. You can supply your vehicle, you can start business using your own vehicle, it's a capital, but not necessarily what money. Good. And it can be injected into the business at any stage of what the business. How we get it? Good. So that is what capital. Now, there's an accounting equation. Let's remind ourselves. The accounting equation states that asset is equal to what? Capital plus what? Liabilities, right? Yes. Now, this capital, we can also call it what? Equity. That's another name. For now, let's assume that they are the same. When we move higher and higher, they are not the same. Especially getting to the end of this topic, I will explain the difference between them. Good. Now, if I'm doing something like this, can somebody tell me make equity the subject for me? Can someone make equity the subject for me? Equity the subject. So asset minus what? Liability must equal to what? Equity. So what's the definition of equity? So how do you define equity? So equity is nothing by what? Asset minus liability. Now, the conceptual framework failed to give us what? A definition and recognition criteria. There's no condition attached to equity. Why? Because it's not on its own. Have you seen how we arrive at equity? We make this guy the subject, right? So we don't have recognition criteria, and because of that, it's very topical. That's why I call it a stubborn guy. But that one, there's no condition. There's no condition. Unlike revenue, that when a customer come and buy the goods and you pass the ownership, record revenue. It's not like that. Equity does not have something like that. Yes. And I remember last two sitting, a sitting before last sitting, I see the question was define equity. What do you tell the examiner? That's a fair question. Define equity and state the reason why equity, the conceptual framework failed to give us the regulation criteria. and come and see students. I don't want to comment. I don't want to comment about some of the answers. But I told that we are not there. You and I were not there. That's years by the that's years the conceptual framework. Now, equity simple means the residual what interest after deducting all liability from where? All asset. That's the definition for equity. So equity is what? Equity is the residual interest that net amount. So equity simple means net what? Amount. So equity, I like them, Mr. Danson. I like your formula. Great. Equity simple means net amount that we arrived after deducting what? All liability. So anytime the examiner asks you what is equity, just code this one from you are done. No definition. Unlike revenue, unlike expenses, where we say decrease in asset, no, don't have something like that. Good. Now let's go to assets. Very topical issue. What are assets? Assets. Assets. These are the items that we are going to report. We are going to talk about it. In fact, I can assure you that your financial reporting paper, we cannot set the paper without these 5 items. No matter what, we are going to see types of revenue, types of assets, types of liabilities, types of expenses. Yes. So if you understand them at the basic level here, when they become tough, you'll be fine. Good. So what are assets? Assets. First of all, I'll give you the basic explanation, then I'll give you the standard definition. Now, asset simple means the bona fide properties of what? Of the entity. Bona fide properties or the economic resources of the entity. That is it. Now, the definition is given to us by the conceptual framework of an asset is that assets are economic resources. They are what? Economic resources. I think these keywords, let me put them. I'll explain the keywords and you will see substance over form in the keywords. So substance over form is everywhere in financial reporting. Now, assets are what? Economic resources, one. Owned and controlled by an entity. So two, condition number two, owned, ownership, right? Legal status. Owned and what? Controlled. Okay. So it means that both the legal and then the substance must comprehend and must say the same thing. So owned and controlled by an entity. Good. Owned and controlled by entity. From past events. From past events or as a result of past transaction. So if you are planning to buy a car, you don't want a car. If you're a company you are planning to build, you don't want a building. Great. From which future economic benefits are expected to flow to the entity? From which word? Future economic benefits. In fact, I like that term. Future economic benefits. So from which future economic benefits are expected to flow to the entity? Future economic benefits are expected to flow to the entity. We are done. That's the definition for assets. So when I ask you, these are the terms that we are going to look for from it. Now, what are the types of the assets? For the purpose of our examination, we are going to learn only 2 types of assets. We are done. There are 2 types of assets. What are they? Current assets and what? And then fixed assets or non-current assets. So let's start with the current assets first. So now we know assets. So assets are what? Economic resources. Why are you saying economic resources? Valuable ones. You cannot operate without them. No business can survive without assets. Yes. Owned and controlled. Ownership legally must be yours. Physically or economic reality, that's the one using it. But the one that controls the assets is the one that receives the benefit, and the benefit must flow to you. Good. So that is an asset. So it means that if you have a vehicle and someone is riding the vehicle, it's not your asset too. You can't call it your asset. Why? You own the vehicle, all right, but the control is not there. The benefit is not flowing to you, so it's not yours. Accounting terms or accounting wise, it's not yours. Good. Now the types, current assets. Current what? Assets. What are current assets? They are current. They are today. We also call them what? Short-term assets. They are what? Short-term. They are short-term. So they are assets that acquired with an intention for resale or to be converted into what? Cash within one financial year. So asset that you acquired with an intention for what? Resale or to be converted into what? Cash within one financial year. So current assets. So current assets are assets that you acquired with an intention for resale. So the underlying word is what? For resale. So anytime you are buying anything, any item that this item, right after the purchase, I will sell it back, then it is what? A current asset. Or anytime you acquire something and say, okay, this item that I'm buying today, within 1 year, I have to convert it into cash. That is what? Asset. Yes. Or I can convert it into what? Into cash. For instance, if I have 91 days treasury bill from the government, within 1 year, I can convert this investment to what? Into cash. How we get it? Now, what are the examples of current assets? One, inventory. We're going to talk about inventory on our balance sheet. Inventory, or we call it stocks, right? That's a local name, international name and local name, right? So they are the same, stocks or inventory. Stock or inventory. Inventories are the goods that you deals in, you buy and sell the leftover, right? Good. We also talked about receivables. Receivables, people that are owing you to the tune of what they owe you. So that is it. It also talks about cash at bank, cash what? At bank, and then cash in hand, cash in hand. So these are what? Current assets. So when I go to the balance sheet and I'm listing the current assets, you know them from here. Not when I go, when we start the financial statement and we are asking for current assets and you are giving me liability. How we get it? Uh-huh. So when you all of this, you are going to meet them again. So that's why we're explaining them here. So that when you meet them, you're okay with them. Uh-huh. Good. So that is it. Now let's go to the other type of the assets. That's the fixed assets. I don't like that name. I'll tell you why I don't like it. It's a bad name. I like the other one more than the main one. It was called fixed assets. But now we call it what? Non-current assets. I like it. I like the non-current asset more than the fixed assets. So let me write the non-current asset. Now let me ask, what are fixed assets? What are fixed assets? Okay, I like that, plant and machinery. What are the definition? What will be the definition for fixed assets? You can tell me. Fixed assets. Although the asset that do not move, right? That's why I don't like that name, because it creates a deception. Fixed assets. Asset which is what? Fixed, immovable. Meanwhile, airplane and motor vehicle, they are one of the fastest moving objects on this earth, but they are fixed assets. Good. So I like the name non-current or asset instead of what? Fixed asset. So some of your exam questions, the examiner may state it as fixed asset. It's correct. May also state what? Non-current assets. Now, non-current assets, they are the assets that you acquired with an intention not for resale. So any asset that you buy or you acquire them with the idea that I am not going to sell this asset. So assets acquired with an intention not for resale, with an intention not for what? Like these parts are not in a note. Oh. Yes, this part isn't here. We did not add it to note. So not for resale, part for what? Why will you buy asset that you're not going to sell it? But for use in production of goods and services. So the underlying word is for use, that's all. Anytime you buy something that or asset that you say, I am not going to sell this, but I'll use it, then it's what non-current assets. So for use in production of what goods and services. So goods and what services. So goods and services. Great. Or for rental. Or for what? Rental. However, and they last for what? More than one financial year. And they last for what? More than one financial year. All non-current assets, they last for what? More than one financial year. So anytime I buy assets, and then these assets, oh, I'm not going to sell this asset. I'm going to use it to produce my goods. Then they are what? Non-current assets. Great. Sorry. Now, so non-current assets, they are assets that you acquired, not for resale, but for what? Use in production of goods and services. So they are done, and they last for more than one financial year. They are called fixed. Uh-huh. Yes, but I don't like the fixed rule because it can create deception. Now let's see the examples of non-current asset or the fixed asset. Now these examples too, there are two types of the examples. We have tangible non-current asset and what? Intangible. Great. So tangible non-current asset, tangible non-current asset. So the tangible ones, examples are, now help me. One, land and building. Land and what? And building. Two, plant and what? Machinery. Three, furniture and what? And fittings or fixtures. They normally move either fittings or fixtures. But what matters is what? F and F. Have you seen? So we can just perm them. Furniture and fittings, furniture and fixtures, or fixtures and fittings. Yes, permutation. They go two, 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 two. Three, computer and equipment. So computer and equipment or computer and its accessories. Four, motor vehicles, including what? Motorcycle or kada. Motor vehicles. So these are what? So in the question, when you see this, you have to put them somewhere and call them what? Non-current what? Assets. Non-current assets. Good. That is it. Now, what about the intangible ones? Some of them do not have a physical character. These ones have a what? Physical character. So these are the tangible. They have a physical character. Here we are going beyond seeing, felt, those stuff that they've been saying. We just group all of them together and call them what? Have a physical substance. Does not have a physical substance. So these assets have a physical substance. The intangible, they don't have a physical substance. Example include one, goodwill, trademark, logo, copyright, patent, license, deferred development expenditure, and you are fine. So that is it. So they are in good word, goodwill, logo, copyright, patent, license, brand name, and then deferred development for expenditure. All of these, you're going to talk about them. All of what you mentioned. So when I read them, and we start talking about them, You'll be fine. You there, you'll be fine. I know for sure that you'll be fine. I'll be get it. Don't worry. Now, let's go to the important part. We cannot define or explain asset without that item. It's very important. Now, we call it recognition criteria. On what basis do you record asset in your book? Is it when you buy the asset? Or is it when you are start using the asset? There must be two conditions which would allow you to record assets. In fact, you can have asset physical, but if that two conditions are not there, don't put them in your accounting books. Yes. So what are the conditions? We call them what? Recognition criteria of what? Assets. So if I ask you a question that can this company record an asset, you have to use that condition. If that two conditions are there, they should record assets. We are done. If that two conditions are not there, you should not record any assets. What are the conditions? Condition number one. So recognition criteria of an asset. Recognition what? Criteria. Or condition that must be satisfied by an entity before they can record what? An asset. And this condition, they are very important. Please, we are going to meet the condition about three times. So three times. Anywhere I reach, I remind you, do you remember when you say yes? Then we move on. Three times. Aside what you're going to do today, you're going to meet the condition how many times? Three. So, and if these conditions are not there, no assets. Good. Condition number one, it must be probable. It must be what? Probable that future economic benefits embodied in the asset will flow to the entity. It must be probable that future economic benefits, future what? Economic benefits, economic benefits embodied in the assets, embodied in the assets will flow towards to the entity. That's the first condition. Please, in exams, if you quote this statement without the word probable, the examiner has every right to mark you down. No argument. If you quote this statement here in exams for a marks and then you don't bring the word probable, the examiner have what? Every right to mark you down. Because in accounting, there are three words that we don't joke with them: certain, probable, possible. In fact, probable is being higher than certain and possible. So that's why we use the word probable. So, like, you have to be sure that this asset I'm recording, I'm the one going to receive the benefit. If the benefit has not flowed to me, I do not record it. And here we're talking about the control, the one that uses it, the one that uses the asset. Please, if you own an asset and you lease it out, you in accounting books, you can't record it. How do you get it? Good, because the benefit has not flowed to you. Don't say that the guy is paying rent. No, rent is different from the one sleeping inside the building. Have you seen? Let's assume that you are at least you've got money to acquire one of the most expensive car on this earth, and your driver, you and the driver who enjoy it, can tell me the truth. You and your driver who enjoy it. I guess the driver. Yes. Well, one day you are not there and then you pick the car and then you don't know where this driver will send it. And now what the most expensive part is that when they're driving cars are not yours, they go on top speed. Exactly. Good. So the benefits will flow to the driver, not the owner. So the driver will call it in the books as the car is for you. That's the accounting. In reality, if you go to law court and go and do that, you return damages. So that is it. Now, condition number two, the cost involved can be measured what? Reliably. Cost involved. So the cost involved or the cost of the asset can be measured what? Reliably. So the cost of what? Of the assets can be what? Measured reliably or can reliably be measured. So can be measured or quantified reliably reliably. Good. Now, here, what we are talking about is this. If you have an asset that you cannot determine the actual cost of it, don't put the asset in your books. In fact, what value are you going to place on it? You're going to do guesswork. Accounting is not guesswork. You have to record what actually happened. So the substance. Now, here we devoid self-constructed assets. Any asset that organization built by themselves. Maybe the accounting department joined the IT guys and they generated or designed accounting package or accounting software for the organization. They use the organization's own resources, organization's own building, light, and other items to generate this software. You can't determine the actual cost of the software because the salary that you are paying to them, how are you going to divide it? That you are going to apportion some towards the software. So here, some of the self-constructed assets, self-manufactured assets, or internally generated assets, before you can record, make sure that you can measure the cost reliably, or the cost can be separated from the entity. So that is it. So here, sister, thank you. Brother, thank you. Assets should not be in the books. Sister, thank you, brother. Thank you. Assets should not be in the books at all. That is it. Now let me ask my question that I normally ask. Please, are human being asset or their liability of organization? Tell me. I'm done with assets. Let me pick liability. Then I'm down with the elements. The final one is what? The liability. So, are human being assets or their liability? Okay, let me ask the question one. The labor force in every organization, how should they account for it? Is it an asset or their liability? Okay. Are human or are labor force asset to organization? Can they record an asset? The asset, yes, the asset though. In fact, the two conditions. So let's see. Would they get any benefit from the human beings? Yes. So what again? So now to answer this question very well and let me score you 4 marks, then it's not like this. To record an asset, to record human being as an asset in the books, then the following two conditions must be in place. Condition number one, there must be what? Future economic benefit flow. There must be probable that future economic benefit will flow from where? The human being to what? The entity. Full stop. Two, the cost of the human being can be measured with liability. Then you come back again, come and tell us which of these conditions has been satisfied. In fact, all the two conditions must be there before you can record an asset. If one is there, one is not there, no asset. So then you come back. Although it is probable that future economic will move or flow from the human being to the entity through their inputs or their outputs, then the cost of human being cannot be measured what? Reliably, and hence no asset. But human beings are the most valuable asset every organization have. But because the last condition they can't perform, you can't measure them. They are not like items that you are going to price it. And I don't want to be fight to. Okay, child, they have work to do. Oh. How are they going to value a human being? They will tell you that okay, by experience or qualification or number of years you spend on the company. So the marketing manager they put 5,000 or 10,000 on his head and then he go and argue. Why? Me I value more than 10,000. Put 50,000. So human beings are not assets. How we get it? Good. Now let's explain liabilities. What are liabilities? Or what is a liability? Don't say it's the opposite of assets. Liability. Liability. So liability. For the simplest term for liability would be what? Obligation, right? So obligation that the entity must pay to the other. Now let's do the definition. We are saying that liability or liabilities are one, present obligation. They are what? Present obligation. Obligation today, eka today. You are owing somebody today, not tomorrow. you're planning to owe someone, it's not liability today. So liabilities are what? Present obligation arising from past what? Event. So past event must result today's liability. That's why we are paying the debt of. Yes. That's why every government come, they'll come and then what? Go and take the loan, go and take the money. But taking it so easy. They know that one day, someone else will come and do what? Do the payments. So they are creating a liability for what? For future generation. Good. So that is so present obligation arising from where? Past events. Good. From which future economic benefits are expected to flow out of what? Entity. From which future economic benefits, from which future economic benefits are expected to what? Flow out of the entity. So, or which will result in an outflow of what? Future economic benefits. So, outflow, underline where this word, outflow of what? Future economic benefits. So, that is what? Liability. How we get it? So, that is liability. Good. Now, now that we know the definition for liability, liabilities, so there are two types. What are they? If the two types of assets are current asset and non-current assets, then what about liability? That one too. And non-current liability. Perfect. So that is it. So current liabilities and what? Non-current liabilities. Now then, if current assets are also called short-term assets, then current liability can also be called short-term what? Liabilities. How we get it? Short-term liabilities. What are they? These are liabilities that must be paid within what? One financial year. These are what? Liabilities that must be paid within one financial year. They are due. So anytime you are owing someone and the deadline is within 1 year, 12 months, is a what? It's a short-term liability. How we get it? Or current liability. Good. Now, what are the examples of current liability? They are one. For examples. So these examples, please, you are going to see all of these examples in your publication. In the question, we are going to prepare financial statements and they are going to list these items for you so that you know where you are going to classify them. Not when you see them in a question and you're thinking, would they be a current liability or would they be a short-term liability or it will be a long-term liability? No, that's not what we want. Good. So example include one, bank overdraft. Bank overdraft. Two, short-term loans. Short-term loans. Short-term loans. Three, payables. Payables, which is also called creditors, right? Creditors. That's local and what? International. Or expenses owing. Expenses what? Expenses owing. If I've not paid for any of your expenses, you are owing. Accrual. Accrual. Good. Likewise, expenses paid ahead of time. That's a prepayment that become a current what? Asset. Good. So these are examples of what? Current liability. So in the balance sheet that we are going to prepare, in a trial balance, if you see any of this, just send them to what? The current liability, and you are done. How we get it? So that's why we do not start preparing financial statement. No, 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 no. Even though that's the main issue, you have to go through what? The principles or the preparation stage, and then we are going by all this. How we get it? Good. Now let's move on to the next aspect. That is what? That is long term or the non current what? Liabilities. So non current liability or what? Long term liabilities. So what are the examples? Now, non current liabilities, these are liabilities that due for payment or they go beyond what? One financial year. So any liability that will take more than one financial year before you settle them, they are what? Non-current liability. What are they? What are they? What are they? Non-current liability. What are they? One, bank loans or long-term loans. Good. Long-term loans or bank loans. Two, bank loans can also be called the loan notes. Loan notes. So another name, loan notes. Then you can also have debentures, debentures or bonds. Yeah, also. Then the third one I'll talk about it is the deferred tax. Deferred what? Tax. Oh, deferred tax. So deferred tax also can be a non-current liability. I am done with the element. These ones are very important. In fact, I can assure you that about 60% of your 60 to 70% of what you're going to do revolve around these items. If these items now you're going to pick them again and start explaining them one after the other. I'm done with the element of financial statements. Good. I'm moving on to the last aspect of the conceptual framework. Now enter into the regulative framework soon. Now, for purpose of our studies, this is okay for a conceptual framework. However, but in the handout I've given you, I move extra to complete the conceptual framework. So the next one will be the recognition and measurement. I will explain them, but we've done them just that we are going to pick each of the item and then we explain them into detail because they are standards. IFRS talks about them, so we will pick each of them. So I'll talk about recognition and what measurement. These two terms are very important. We're going to use them. And please try and also use them when the need arise in exams. Try to use them. Yes. One, recognition. Recognition and what? Measurement. Now, what's the meaning of recognition? Recognition. Now, recognition simply means reflecting, recording, accounting for a particular transaction in the financial statement. Are you going to reflect it? Are you going to record it? Are you going to account for it in the financial statement? That is what? Recognition. That's the accounting term for recording transaction what? In the financial statement. If and only if it meets or satisfy a certain criteria. We cannot just start recognizing items or just start recording transactions and figures in the books. Why? Because we are accountants. No. If and only if it satisfies a certain condition, like we solve for assets. Did you do for liability? Recognition criteria for liability, you didn't do it for it. There's a criteria for it. In fact, I think I have to do that one too. It's a reverse of what we did for the assets. The recognition criteria for liability. Let me go through. Is what we did for the asset, the two conditions for the asset is a reverse. So let me do that one before I come in. In fact, all of these have a what? Recognition criteria. A condition that must be what? For before we call them. Except what? You can tell me. Which of these five items does not have a recognition criteria? The stubborn guy. Equity does not have recognition criteria. But aside equity, all the other ones have recognition criteria. Now, let me chip in this. For liability, the recognition criteria is that one, it must be probable that future economic benefit will flow out of the entity. So, if you have any debt that will not result any payment, that is not a debt to sister. Thank you loan, brother. Thank you loan. Where the loan they're not going to pay back. They're not going to pay back at all. It's not a liability. Are you owing somebody? Good. So it's not liability at all. So there must be what? Outflow. Probable that at least it will not an outflow. And then the last one says that the amount involved can be measured what? Reliably. If you don't know how much you owe the person, please don't put it inside the books. How big get it? These are the conditions. So recognition simple means anytime a certain transaction satisfy some condition, it must be what recorded or it must be recognized. How do you get it? Good. And then recognition. What about measurement? The word measurement in accounting. Measurement simple means value. How do you determine what? Value. So recognition will talk about, are you going to record it? Oh yes, record it. Now, recognition sometimes talk about the real. Recognition talks about the real. Are you going to record it? Yes. What type of the element? Okay, revenue. Depending on the features that it exhibits or depending on the condition. Good. Measurement talks about value to be placed on the asset, estimating the monetary value of the transaction or the item. Happy get it. Now we are going to do it, and that's the most difficult section of accounting. These sections are theory, these ones are the calculation. Most of all, like about what they're going to do is about how to get a value, how the asset must be valued, how the asset must be what measured with. So that is it. Now, let me give you a real life example. When you go to a program, when you go to a program, normally the big guys, when you go, you know what their wife or their husband asks them first? Ah, did they recognize your presence there? Oh yes, so what value they place on you? Oh, I was the co-MC. So have you seen he was what recognized, he was handed at the party or at the program, and then the value placed on him was what co-MC or he was common family member. Oh, in fact, they didn't even mention, they didn't even see me at all. They didn't even see me. Oh, no recognition criteria. That means they didn't specify any condition. Oh. That's why they don't recognize you because they didn't specify any condition. And they don't put any value on you. So that is recognition. In financial reporting, the examiner is going to mention it. And it has been recognized as an asset. And it was measured at cost. That means it was valued at cost. These are the terms that we are going to use. So if we understand these terms very well, when we prepare financial statement, no one can challenge us. How do you get it? Now, I am done with the conceptual framework. The remaining part of it are reading. So do justice to it for me. I left it two topics in it. That two topics fall outside the scope of our learning. So you can read them for me and then you'll be fine. You can read them for me and then you'll be fine. They are one, the measurement basis, and then the concept of capital maintenance. Concept of capital maintenance. All of them, I've done video on them. So for those who want more like on the complete pack, I'll forward the video to onto the platform and then you use that one, then you'll be fine. Let me go straight to the critical ones. Let me clear the critical ones. So we are done with the conceptual framework. So now dear, we know all the principle that form the basis of the financial reporting. We know why we prepare financial statements. We know the assumptions, the concepts, the principles. We even know the features that the financial statement must exhibit. And we even know the element that must be in. And we even know when we should record that element. There are recognition criteria, right? Good. That's great. And now we're going to look at what? Regulatory framework. Regulatory what? So regulatory framework of financial reporting of what? FR, no shortcut. No shortcut. Good. Now, regulatory framework of financial reporting. If the conceptual framework talks about concept, principles, assumption, basis, then regulatory framework will talk about what? Any idea? Regulatory framework will talk about we'll talk about rules, regulatory. So rules and what? Regulation covering financial reporting. If the conceptual framework talks about concepts, principles, assumption, basis, convention, practice, phenomenon, tradition, beliefs, then the regulatory framework talks about regulations and rules. So here we are going to learn rules. What are the specific rules or laws govern financial reporting? That is it. Specific word, rules or laws govern financial reporting. Or is there any regulation govern financial reporting? That's all. So now we know how to prepare the financial statement, and now we're going to learn what the rules. Uh-huh. So that is it. Now, in Ghana, what are the source of laws for financial reporting? You should know them. The source of law for financial reporting. The source of law for financial reporting. One, the source of law for financial reporting. Source of law. Like where do we get our source from the regulation? Where do we get it from? What are the source of rules that govern the financial reporting? So source of laws for financial reporting for FR close of capital. One, the company's what act or the company's code, right? So company's code, but they're using the drivers. Company's code. So let's use act code. Act what? You can tell me the full version. Hey, hey. I want to go. Yes, I like that. 2019 what? Into bracket Act 992. Good. So that's the company's act. Not the 1963 Act 179. That one was passed out like in 2019, 1st August. So that was last year, right? Hey, it has been a year. Oh. That was exactly a year. Yeah. So 1st August 2019, they passed this act. Now the company's code gives us the mandate and usher companies to prepare financial statement and even give them the preparation steps, which states that at least the account must be prepared and audited once a year. So that's the source of authority to usher companies to prepare financial statements. That is it. Good. Now, two, we can also talk about the stock exchange. Stock what? Stock exchange or the stock market. If you're a listed company, they also give you instructions, rules. Report some of your market index. How a listed company will prepare their financial statements is slightly different from what that of the unlisted. The listed go beyond unlisted company because if you're a listed company, there are some key market index must be in your financial statement, such as what your earnings per share, diluted earnings per share, EPS, all of them, and then the dividend yield. It must be in there. But if you're not a listed company, you don't need to include all these ones. Good. The third one will be directives or the instructions coming from what African Union or European Union. They can sometimes tell us, okay, can prepare the financial statement this way, that way, and we adopt it. It sometimes shape our financial reports. Then I'll talk about the conceptual framework. That's the next one. Conceptual framework. It also gives some sort of rules. Conceptual framework. Wow, good news. We've done it. Then the last one is the IFRS, Financial Reporting Standard. Financial what? Reporting Standards. We are done with this. That conceptual framework, we are done with it. So we're not done with the IFRS. We are going to do that one. In fact, regulatory framework basically talks about the financial reporting standards. Uh-huh. So that is it. Now, someone will say that, Fred, what about Bank of Ghana What about Bank of Ghana's Act? What about if you are bringing Bank of Ghana's Act, then to bring Audit Service Act. Have you seen? Now the issue is this: those acts it govern a particular people, but these companies could once you're a company. In fact, even if you're a bank and register your bank under the Companies Act, this one binds you. So this act don't know bank, don't know minerals commission, don't know anybody. It's no all what's in is for companies. Limited. Great. So that is it. So aside this one, we may have specific companies and specific industries and their what regulations. So industrial laws, when it comes to banking, the banking laws are many. Yes, you know it. That's a legal framework. Bank of Ghana's Act, let's go. Again, the Banking Act, all the Banking Act, let's go. Bank of Ghana's Act. Hmm. Hmm. Don't worry, you'll be fine. Uh-huh. Yes, that one. Money Laundering Act, I like that. All of these ones. What again? There are two, eh? You are your acts are many than all the other. God, the banking laws, that's what they tell us to do for establishing bank board. The laws are many, special deposit act, right? Just that this act does not govern what company, the other companies. Manufacturers don't go by the banking act, right? So that one industry specific, but we are talking about the general view. Good. Now we are done with the conceptual framework. IFRSs. So now the issue is this: the IFRSs will tell you how to prepare the financial statement. Will give you the issues, how to treat the items, how to prepare the financial statement with IFRS, specific issues. But the company's code will tell you the legal status or will usher you. So the company's code will tell you, go and prepare it. It has ended. IFRS will come, I'll help you to prepare. Have you seen it? So companies could go and prepare, audit it, prepare and audit it. IFRS and consultation will say, okay, don't worry, come, I'll show you how to prepare it. That's all. So have you seen it? How nice they are. Good. Now let me ask this question. Why do you think Ghana, for instance, we don't have money to construct road, but we have money to pass acts? So what's the need for the act? What's the reason for the regulatory framework? What's the main reason for the regulatory framework? We don't have money to build roads or to build schools, but we have money to what? Pass acts. So why is the need for regulatory framework? Now, to protect the interests of what? Investors or stakeholders. Protect what? Interest of the stakeholder. That's why there's a need for all these regulatory bodies, all these, including the state-owned regulatory body or measure, and then the IFRS is the International Financial Reporting Standards. Now, if you're going to invest, let's say you're going to invest in China, and China, there's no law governing financial statement preparation. Anybody can prepare something representing something. You go and invest your money there. You ought to be happy. These people, you'll be happy. So to protect the interests of any investor, then we have to set a tight laws, tight condition, usher people to prepare financial statements in the country. So that at least the investor will see what is going on, or the investor will be furnished with what information on regular basis. Not as and when things are going good, they prepare financial statement. When things have become bad, they no financial statement, right? Not at all. Good. So now we are done. Now, the main IFRS is we are going to look at how it originated. Don't worry, these are the areas that we don't like it at all. Someone don't even want to who don't even hear the IFRS. Let it be your friend, okay? Yes. So we are going to look at how it been formed, who even formed it at all, and then the other functions. That's great. Just a second. Now, some of the standards, we will also learn how or why some of the standards are called. For all of them, they are what? Financial reporting standards. But some are called IAS. IASs. So International Accounting Standards. Some are also called IFRSs. Wow, IFRSs. International Financial Reporting Standards. We look at why. So the financial reporting standards that we are going to learn 30 minutes ahead of us to finish it up revolve in this. Good. Now this standard, who even set it? How? So let's start by this. There are some people or body that their sole aim is that they have to prepare and issue their financial reporting standard. In fact, it's supposed to be for the IFRS Foundation. So the body will be what? IFRS Foundation. Foundation. Just that these people or this body, if your duties are many, then you have to do what? Delegate some of them, especially the ones that are not, you don't have upper hand over it. So you take off for the critical ones. Good. So they're supposed to prepare and issue the financial reporting standards. But they have what? Delegated that function or they form a board. And then that board will ensure the IASs. So the board is called IASB, International Accounting Standard Board. How we get it? Now if you remember, thank you. They are the same people that they own what? The conceptual framework, right? They're the same people that they brought the conceptual framework. Now these people, the board, their sole responsibility or sole aim is to prepare and issue the IFRSs. Is to prepare and issue what? The IFRSs. That's great. So the sole responsibility for the standard, no one apart from this body, no one prepared the IFRSs. In fact, not even the IFRS Foundation. So it is in the hands of the board, IASB board. So they have to prepare and issue what? The IFRSs. IFRSs. So that's their main aim. Now, the IFRS Foundation, they have four key roles or key functions. What are they? In fact, they appoint. So they will appoint, they will fund, they will do what? Fund, they will govern, set a governance policy, instructions. So they will govern and they will do what? They supervise, you call it oversee. They will just supervise the activities of what? The board. So if someone appoints you, they can also sack you from the board. Oh yes, so but the guy that have the right hand also have what? Left hand, right? That's it. So they appoint members onto the board. They fund the board's activity and they do what? They govern, set policies for the board. How we get it? That's great. Now, if someone fund you, governs you, oversee your activity or supervise you, that is in the when everybody is young, you fund your children, you set policy instructions, you supervise them. Now what do you expect from them? Reporting. Exactly. So it means that they have to also what? Furnish report back to what? Their boss. Have you seen? So the rules of ISB now it can work three. One, the conceptual framework that they have to prepare, and the main one is what? The IFRSs. Third one is what? Furnish report to what? To the IFRS Foundation. Because if someone have appointed you, then that person might need information from you. Good. Now, this foundation, in fact, this foundation, they are not the raw boss. Oh. But if I should start the raw boss, and you stand up. Let us start from here like this. It start from IFAC. IFAC is the raw boss. You've heard it before, right? International Federation of what? Chartered Accountants or accountants, not chartered accountants, just accountants. International Federation of what? Accountants. That's the IFAC. There are two sub bodies. We have the public sector, then we have the private, and in the private too, we have the monetary board. The monetary board. The monetary board look after the IFRS. So the IFRS have their boss. Oh. All of this is a sub unit under the IFAC. Sub unit. So IFRS is just coming from a sub somewhere. So these people that we see them as boss here, they have their boss. Oh. That boss is called what? The monetary board. So the monetary board supervise and then monitor the activities of what? The IFRS Foundation. So boss over boss, right? That's grand boss. Good. So that is it. Now, they also form other council and committee. So they form the advisory council. Advisory what? Council. What do you think will be their main responsibility? You have to what? Advise what? The board on how some of the standards be what? Formed or developed. You know, they say ideas don't one person's head though. Have you seen? Because this what they are forming, this IFRS is almost every country. Like a lot of countries are going to use it. So it's not something that one person to go and hide somewhere and put something together to represent something. When it come out, someone may challenge you. Good. Now they also form another committee. If I recall them interpretation committee. Interpretation committee. What do you think will be their function? The main aim of interpretation committee. Interpretation what? Committee. Now the standard issued by the IFRS, sometimes they are too what? Technical. So it need to be explained further, or we have to tell the actual meaning of them. So there they provide what? Explanatory notes to that of what? The IFRS is or to the board. So that they were accompanying with the IFRS. So that if you don't understand the standard, don't worry yourself. Learn it from the explanatory notes, you'll be fine. It's like Ghana. Anytime we pass an act, there must be what? Regulatory or there must be practice notes. Then that is it. So this is what the governance structure. Have you seen how nice you've drawn the item? All what you need to know are their functions. That's what I'm done. Their functions, I'm done. IFRS Foundation, what's their function? Now let's see the objective. Now, these two people they have common objective. A and then B. They have what? Common objective. Because this IFRS, we said that the foundation is supposed to set it by themselves, right? Yeah. And if appointed people to do it on their behalf, then they'll have a common objective. What you're supposed to do, if you appoint someone to do it for you, then the objective is the same. Yes. So these two people have a common objective, but the role or the function that they perform are all different. Good. Like CIB, Fred, and then you. Have you seen? We have a common objective, but the functions are all different. Objective is what? To provide what? Or to develop what? Qualified bankers or chartered bankers. Good. But CIB have to award certificates. I have to provide the way. You have to go and sit and write the exam. So And sometimes come and mark it to everybody is function. Have you seen? An objective are what? One. So that's the same thing applies here. These two people have common objectives. So what are the objectives? So objective of the objectives of the IFRS Foundation and the board, they are the same objective. They have the same objective. So objectives. Now, the objectives, you should know five. I'll give you three. Just add two to it. Why? These areas are very sensitive to your paper. Good. What are the objectives? Now, one, to develop high quality. So develop what? To develop high quality. Not not poor standards, oh, high quality. Not fake ones, oh, high quality, not China ones. Oh. No version A, version B, version C, oh, not at all. So high quality, globally acceptable financial reporting standards. So to develop high quality, globally acceptable financial reporting standard or accounting standards. How we get it? So that's the first objective. So the objective is to what? Develop what? High quality. In fact, globally what? Acceptable financial reporting standard. How we get it? That's why the IFRS is international. How we saying international? It's around over 100 countries are using it currently. Good. Objective number two, to promote the use of the IFRSs, because after preparing and then going through tough process to develop the standard, they shouldn't just put it under their pillow. No, they have to sell the good news of the IFRS so that a lot of people will adopt it. So the second objective is what? To promote what? The use of the IFRSs. To promote the use of the IFRSs. So to promote the use of the standard, that is IFRSs. And I'll give you the third version. Then the remaining four and five is coming from it. So that's homework number two. But every time there'll be what? Homework, homework. So if you pile them, then to be compiled. We call it compounding, right? To be more, 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 more. So please, as and when it comes, let's do well and clear them. I know that one day, one of one of this homework will pop up in exams. Like what happened 2018 November. Good. Now the third one is that to reduce the alternative treatment of the accounting transactions. To reduce what? The alternative treatment. So that's the objective. Other than that, if I should give one transaction and call 100 accountants, all of them give me different treatment. Oh yes, everybody is version, everybody is style. Other than that, they will be influencing this financial reporting. And then to be like subjective. But oh, give it to me, I'll do different thing. Yes. So you have to make sure that the IFRSs or there's been standardization in reporting. So to reduce what? The alternative treatment of what? Accounting transactions. So to reduce the alternative treatment or the number of alternative treatment. Some of the transactions, someone is having three versions. One person alone is having three versions. If I should call five people, then I can get like 30 versions of the same transaction. So there will not be standardization. And where there's no standardization to, We cannot compare the financial statements. You can't compare. You know, banks, some of the branches are operating in where? Nigeria. So how can you compare your performance, branch performance, Ghana branch, Nigeria branch? You can't compare because they don't have the same standard. Whatever accountant is doing in Ghana is different from whatever the accountant is doing in what? Nigeria. You can't compare the performance. How we get it? Good. Now I'm done. I am done. You are not done. You have to. But I think the book I provided four. So that means you have to add one extra to it. In the book I provided four there. Now that is it. Now we are going to learn how the standards are being formed or set. A very topical issue. Now before that, I'll like to explain why some of the standards are called IASs and some are called IFRSs. So you shouldn't say one financial reporting standard. Why some are called IAS? Why some are called IFRSs? Shouldn't confuse you at all. Now this is it. In 1966, some group of people sat and said, okay, can we have some laws and principle governance so that will bind us, so that will give us standard way of doing things? I said, yes. So, they say COVID have what 14 days period them to from 66. And they brought the idea. They are in their what? There's a term for it. What's the term that we use? COVID take 14 days before it will take effect in your body, right? Before it's the effect. Incubation. So the incubation period. Them to until 73. They started issuing their first. So 7 good years after the plan. So incubation period of the IS was 7 good years. Wow, they did well. Ghana and the same year and give issue. Forgive me, forgive me, forgive me. It's not Ghana, other country. Now, so from 73 coming, and then they started issue the standard, and they call it what IAS. So they were issued, and it was nice. So from 1973, they started issuing their first standard called IAS. So that's where we have the IAS. So they start IAS 1, IAS 2, in that order, up to IAS 41. So in April 2001, something happened. They realized that some of the standard issues in 70s, 80s, 90s were no longer applied. The requirements are out of date. Business are growing, expansion, rates are increasing. Now, new things are, in fact, a lot of high expensive machines, a lot of inventions are coming. So, some of the standards, in fact, most of the items are not even captured in the standard. But they are new items, they are new. So, their standard, in fact, their standard captures what they think is there or what they like, they repeat it, like transaction normally repeat itself. So, from 1973 up to 2001, nothing's will change, right? So they have to now update, do major. In fact, they did what you call major overhauling, not small one cry. So now they started deleting from 2000 and what one. They started deleting the old standard. The standard that no longer apply and bring what new one. Now when the new ones are coming, they come with a new name called IFRSs. So the new ones bear the name what IFRSs. How we get it? So now when they delete the old standard IAS and they want to replace it, they will replace it by what? IFRS, International what? Financial Reporting Standard. Who can tell me why now they don't call it IAS? I bet they could have probably changes the issues and bring it back that revision of IAS. You realize that the word accounting is a bit small, right? You say accounting. Accounting is like bookkeeping, accounting clerks. So if like you only change the name to IFI, financial reporting. When they say financial reporting, it's a bit mature than accounting, right? Uh-huh. So they call it IFRSs, financial reporting standards, and they start issue. So in 2001 April, that's where the IFRSs they started issue the IFRS in 2001 April. How do you get it? Had to replace the out of date words IASs. So the IAS out of the 41 currently, in fact, there are 28. They've deleted most of them. So IAS 1 is there. IAS2 is also what? There. IAS 3 cancel. IAS 4 cancel. IAS 5 cancel. In that order. So there are potholes in the IAS. Why? Because they have not cancelled. But the IFRS, there's no pothole. It's from IFRS 1 up to 16. In fact, 17 they are done. They'll publish it soon. So the IFRSs start from 1 up to what? 16 currently. Even though they are done with what? 17. In fact, they are not done with 9. But they are done with 10, 11, 12, 16. Up to 16, they're not done with 9. We will see why they're not done with 9. Now the issue is this. The standard very soon, 50 to 100 years out of us, all the IAS will go, they will cancel all of them. And then you replace it by what? IFRS. So as and when you get older, let's take it off. In fact, this name, ISB, it was not called ISB, it was called ISC, cancel or COMT. So when they do the major overhaul and it affected their name too, have you seen? And now they are calling them board. In fact, all of these people which affected them, all of this were not called IFRS, but then they don't know IFRS. What they know is IAS. So after the measure of power. So the issue is this. Out of the 16 IFRS, not all of them we are going to learn. Out of the 28 standard, the IAS that remain, not all of them we are going to learn. We are going to learn some of them. Maximum, like we are going to learn maximum of 12 standards. So you should know 12 standards. And then they are going to, these 12 standards are not coming from your syllabus. According to my analysis from the previous sittings, your examiners participation trained. Now, these 12, maximum of 4, 3 up to 4. So from 3 up to what? 4. So out of the 12, you are going to meet only 3 up to 4. That's it. But for the financial statement preparation, you need it most. How we get it? We need the IFRS system most. So that is it. And then you'll be fine. So now we know why we have IAS, why we have IFRSs. So in simple quotes, IASs are from where? April 2001. Below April 2001, IFRS from where? April 2001. Please, this is not part of your examination. No examiner have time to examine you this. No. It's not part of your examination at all. Yes, but normally it confuses. So that is it. Good. Now let's go and learn what you call advantages of what? International harmonization. Now, what do you think will be the importance of these IFRSs? Or what do you think will be the importance if these IFRSs are being what? Harmonized all over the world, or many countries adopt and use the IFRSs? Tell me the importance. So that's the importance of the IFRSs. We call it importance of what? International what? Harmonization. Uh-huh. So importance of international harmonization of the IFRSs. Importance of international harmonization of the IFRSs. So from henceforth, if I mention IFRSs, we are referring to the IESs and the IFRSs. We like call it IFRSs, not IESs. Why? They can tell me that it's because of what? The change that they did. So now most books, when you see them writing IFRSs, meaning we mean both the IFRSs and the existing ones, all the existing ones. So that's the meaning. So just that we cannot write IFRS and IAS. We like the IFRS more than the IAS. Now, what do you think will be the importance? The importance, if this standard is being harmonized, almost all every institution in the world are using IFRS. Standardization, I like that. So When does standardization, what do you think will bring? It will improve what? Comparability, right? So the first important word, it includes or it will improve what? Comparability. So improves comparability. So that means financial statement prepared in Benin can be compared to Togo and Ghana. How we get if they use the IFRS to help them they use the IFRS to help them than the national shrine. That is it. So it improves what comparability. What again? Let's assume that to a multinational company or multinational investor. You have a lot of companies in different parts of the world. If they use the same word, financial reporting standard IFRS are the same everywhere, then they can compare their performance easily. Yes, because branch analysis or subsidiaries in different companies or in different countries can be compared. The performance of the subsidiary can be what compared. Two, transfer of staff. Transfer of what? Of staff will be so easy. Accountants in Ghana can also serve as accountants in what? UK or Nigeria or Togo or South Africa. Now, this one normally happens for the audit firms. You can see that sometimes they will transfer one of the audit partner, that of Nigeria, and they will bring foreign audit partner to Ghana. If the standard are not the same, do you think will happen? No. It's because the standard are the same. So when they come, they are not going to do anything new. It's the old standards. The same standard they apply there, the same time going to apply here. So you either let the transaction occur. They're going to use the same rule. Good. Three, you can talk it will reduce what? Audit cost. Reduce audit cost. How? Audit cost. Now the auditors, police people that without uniform. Police people without uniform. Now, auditors, the more time they spend on the audit work or at your premises, the higher the audit cost. Yes, but they charge according to the number of hours they spend there. Good. Now, if you use IFRSs, it will reduce their time because you are already using the international format, so they don't need to stay there for long. Other than that, they have to one. If you're using a different standard, they have to one come and learn what you are using. Two, after learning it, they have to now see whether you got it right or wrong, or they have to convert your financial statement to the international one, and it will take time. And the more it's taking time, the more the revenue is going high in your pockets. So that is it. So reduce what audit costs. Four, easy access of finance. Easy access of what? Finance. If going to pick maybe if we're going for advance international advances, let me take most of the African countries. I believe strongly that they were forced to adopt the IFRSs. Once they're going to pick, why are they going to take their loans or their foreign debt? Now I'll give you a homework. Ghana, we adopted the IFRSs in 1st January 2007. Who was the president by then? Hey, okay, that's great. They do well. Yes. So tell me why Ghana we adopted the IFRS. If not that, tell me. I'm not saying we went for a loan and then they sack us so that we come and then adopt the IFRS before as a loan covenant. But most of the African countries they adopt the IFRS because it's in a loan covenant. What bank will tell you to use IFRS before they'll give their loans? IMF did the same thing in 2007. So I want to know why Ghana adopted the IFRS. So that's your another trial. Read around it. Why Ghana adopted the IFRS? What prompts? It's not the same year that we changed our money, 2007. Wow. Okay. That's something new. Okay, that's fine. Good. So these are the main importance of what the international harmonization. There are other ones that you can talk about it. It will improve what accountability to help the stakeholders or those that charge governance to what account on their stewardship. So it will improve what accountability. Yes, because IFRS will tell you to account for each and every single transaction which has occurred in the organization transparently, fair. All of this will be improved. Good. Now let's go to the disadvantage. Now here, the disadvantage of the IFRS is it will deter countries from adopting it, right? So countries will base on the limitations of the IFRS and then complain that they will not adopt it. So normally we say barriers to international what harmonization, which is the same as what disadvantage of what the IFRS, the bad news. Now, sometimes there are issues that will deter countries, companies from adopting what the IFRS is. What are they? What are the barriers to international harmonization? So that's the next thing that we are going to do, and then we are almost through. Barriers to what? International harmonization. Barriers to international harmonization. To international harmonization. Now tell me, what do you think will be the barrier? Now consider Ghana, Togo, South Africa, even Benin. Yes, and then India and China. Do we have the same legal system? Our legal system are different. So sometimes the legal system will not support the IFRSs. So to serve as barrier, they will not accept it. If like go to wherever I want to go and come, they will not accept it. For instance, the the Saudi Arabian, the Arabic country, they will not accept it because their Sharia laws conflict with what IFRS is. They will not accept it because their legal system is different from your legal system. Now, US, they are using what? Rule-based approach. UK, you are using what? Principle-based approach. Different legal system. Ghana, we are using principle-based. That's why we are in IFRS comfortably without facing any difficulties. Good. So, different legal system can serve as what? Barrier to international harmonization. How we get it? Good. Different legal system. Different legal system. Different legal system. Two, two, the need of financial reporting. The need of financial reporting. Need of what? Financial reporting. You know, some countries, you only prepare financial statement if you owe the government. Oh. Some countries you only prepare financial statement if you are going to pay your taxes. Oh. So if you are not going to pay tax, don't prepare financial statement. So it means that the needs are different. So if that company or if that country does not need financial reporting so much, then you will not accept any law governing financial reporting because that's not the central focus. That's not the main aim. They're looking for how to build expensive weapons. I are telling them about reporting. They're looking for where to build expensive weapons. I said they should go and report. They don't even accept that your IFRSs. But they don't see any need of financial reporting. How we get it? Good. Now, three, we can also talk about culture differences. Culture or what? Differences. Or culture crash. Culture differences. Culture differences. Now, compare the culture of India, China, South Africa, and Ghana. You can see you're bringing one IFRS or one standard to govern all the financial reports. In fact, culture of every country, one way or the other, translates into their reporting. Yeah. So as a result of culture difference, if Indian man find out that his culture will be what underrated after a certain IFRS, they will not. They will not. Now look at Ghana. When you go to restaurant and start eating with your hand, they'll laugh at you. Yes, they'll start laughing at you. Why? Because they prefer the spoon. Now, even the Chinese man who made the golden spoon still eat with their chopping sticks. Nothing prevent the Chinese man eating with their what their chopping sticks. In fact, now we have Ghanaians who are learning how to eat with the chopping sticks. Tell me I'm lying. Tell me we have Ghanaians who are learning how to use. I'm not saying it's wrong. Oh. I'm not saying it's wrong. Yes. But culture differences. Some people hold their culture high esteem that they will not throw it away. So such a country, they will not adopt the IFRSs if the culture contradicts the IFRSs. Now, currently Ghana, one of the standards conflict with our company's code. IFRS 10, consolidation, it conflicts the company's code. So different legal system, it does not support. IFRS is saying different thing. Companies code also saying different. So what do you do? So if there are more contradictions, there are more differences. Such a country they will not accept it. Yes, you can't send this one to North Korea. Exactly. They'll just call you and then you will see. Well, that's it. But the cultures are different. Different. So one single rule will not probably help us. Four. I'll talk about the need of developing country. Need of what? Developing country. I don't understand why always when I get here, I'm not that happy. The need of developing country. In fact, what developing country needs life virus though? Can they eat it? When poverty is engulfing some part of the world, would they go and then get the vim to go and then report on their financials? Well, we have poor roads. Why some of the country, what they need is not the IFRS. They need what? To develop their primary sector before they move on to secondary. And finally, they will land themselves on smooth tertiary. But they are now at here. Now this one is poor. So the need of developing countries is not the IFRS. So it will serve as barrier, they will not accept it. If one country is seriously fighting poverty, I'm not sure that country will accept the IFRS. If one country, because see, before you can go and report, make sure that your private sector is well developed, extraction sectors, farming activities are okay, food are okay. Now when it went on lockdown, within a short time, tomato, I don't know, tomato became expensive to the extent that tomato was as if it was the vaccine for COVID. And they're using IFRSs. So in fact, it got to a time that other people were rushing to the market, going from office to the market, go and buy food. But the private sector is not well developed. And nobody does IFRS. In fact, IFRS is, in fact, no man accountant, they never prescribe any person, any IFRS for COVID. Now, after you do your primary extraction, farming, raw materials are in countries very well, then set up industries to convert these raw materials into what finished products. Now, when these ones also been developed well, then go to service. Now go to service and then the trade. Go to the banking, go to the audit, go to the accountancy. If food are not there and you have only money, what are you going to do? Buy it. How we see it. So that's what always we will be in negative balance or we'll be in debt with our foreign currency. Why? Because we buy more of what we consume than what we produce. So developing countries do not need IFRSs, not at all. Then the next one I'll talk about is nationalism. It's a very topical issue. Nationalism. to also serve as barrier for people to accept IFRS nationalism. One country is not what ready to accept the other country's what item. That's what you know. One country is not ready. In this country, I don't want their product. Now, US and UK, I don't know what's wrong with them. US and UK. Now it's between US and China. Eh? Now, the US have not accepted the IFRSs. Yeah, why? Because the thought is coming from where? UK. UK is saying that now, the IFRS or the IFAC is non-governmental institution. And the US also say, oh, you think you don't know, eh? Where did you start from? 1966, where did you start from? Where did you be your first headquarters? Where do you go for your international meetings? So we know. But UK is saying no. It's what non-governmental. So it will deter. Once they know that this is come from this country, they're not going to accept it. So some of the countries don't like other countries' items, so they deter them. Now, US, they are using what you call the US gap. Ghana, before we adopt the IFR, we are using the Ghana gap. I don't know where it is Ghana. Now, the US gap, the US is saying that their local standards, that's the US gap, is more or is far better than the IFRS, so they will not accept it. Now, do you know what the IFAC is doing or the IFRS Foundation is doing? They've sent team of professionals to US to analyze and come out with a difference between the US gap, generally accounting or acceptable accounting principles. So that's the gap. Now, the US gap and then the IFRSs. So the team will do one, find the differences and come and report it to us. Now, you know what they will do? Now they will delete the difference in the IFRSs. Automatically, the US gap and IFRS become one. See, one. And now they've accepted it. So if they don't want to accept it, it's straightforward. We know how we do to work for them to accept it. So all what you have to do is wait, relax. Let's go and learn the difference and let's just break the difference. Now currently we have five differences between the US GAAP and the IFRS. There are five differences. Five main differences that are totally different. This one is saying different, one is also saying different things. So if those five differences will be deleted, or then there's no difference between IFRS and what? US GAAP. Now currently, South Africa is not using Egypt. Egypt and South Africa. They're not using what? The IFRSs. Now in Egypt, if you're in Egypt, only foreign companies are permitted to use the IFRSs. The local companies do not use the IFRSs. So if you're a foreign company, you are allowed to use the IFRS because you are coming from a foreign source. Yeah, so you are allowed to use the IFRS. By a local company, not at all. Use the what? The Egyptians what? Law or the gap. And fine. Then I'll talk about the sixth one, cost of training and retraining. Cost of what? Training and then retraining. Cost of training and then retraining. Cost of training and retraining. Now, this can also serve as barrier. This can also serve as a barrier for international harmonization. If a country is seriously looking for money to build roads and then cater for lives, would they get money to go and accept IFRSs? Because they will incur costs to train their what? Their professors. 2007, you have to organize workshop. And you know this government issue, they will end up like people do take this as advantage and benefit themselves, right? Good. So the cost involved can even serve as barrier for some of what the country to accept it. I'm not ready to train my people. It's okay. So that is it. So these are the barriers to harmonization. And sometimes you know human element, reluctant to change. I like where I am. I like where. We don't want change. So we can also bring it in as barrier to harmonization. Yeah, human element, that's the reluctant to change. I am done. Now let the last topic, then we are done with the regulatory framework. That's good news. Oh. Wow. Now, what I want to do is very important. What you've done is important. Now, in October 2018, they brought what you want to do. So that means the next one, which is very important, is what you've done. The important and then the barrier. Yes, they have not what dropped. Uh-huh. So we'll take the last aspect is what? The process or the stages or the steps in developing of the IFRSs. So what are the steps that the ISB, that's the International Accounting Standard Board, the steps that normally goes through to develop what the IFRSs? Okay, we have given it a nickname called the due process. Let me see, the due process. So the process that the board normally goes to develop what standard. Please, this process we don't have for new and we don't have for what? For old. We don't have process for new. Like if I want to issue new standards, then um, use this different procedure. If I want to update, just revise. Revision is different from what bringing new. Oh, some of one of keywords we added that. So let's just change those keywords. That's revision, right? Some of the requirement is too old, so let's just change. By bringing new standard, all this require the same process. Whether you are revising just a word in a standard or you are bringing new standard, all of them go through the same process. How we get it? So don't let the examiner confuse you and say, okay, what are the steps that the IFRS is or the IFRS Foundation or the board normally goes through to update an existing standard is the same procedure. So step one. So they are step. Step one, agenda consultation. Agenda what? Consultation and plan of work. Plan of what? Of work. So first, you have to consult agenda. Consult for ideas. Now, yeah, the board have to hold meetings with the advisory council for ideas, for advice, how the standard should be what should be developed, and then the reason why are we bringing this standard. Are people calling for it? No, people are calling for funeral standards, including me myself. IAS 44, IFRS 20, they should come on funeral standards, standard that will govern funerals and engagement and weddings. There's no standard for it. So it could be idea. So the idea is each and every standard have a purpose, an idea on which they build that standard. The first thing is the agenda consultation. So the agenda consultation, here we seek ideas and then the main issues from where? From two sources. One, internally and externally. Internally, the board seek idea from where? The advisory or council. So they go to advisory council for advice. So you can start like, hello guys, we want to issue standard called IFRS 20. That is preparation and presentation of marriage certificate. What do you do? Okay, okay, man, people are so happy. So let the things be sweet. Let the words instead be sweet. That's all. We get them, don't worry. But for funeral, they are so sad. So don't let sweet things come inside. Yeah, and they will not enjoy it. Console them. That is it. So that's the idea that they will probably seek. Now, aside the internal, you can also have external consultation. Now, the board, IASB, every year they pass documents around to all the member states or countries or institutions that use the IFRS or that have adopted IFRS. They will give you a document. Ghana, ICA will adopt for us, represent the country. ICA will go for it. Now they will ask you to tell us or name any challenge or outline any issues that you have with the existing standards or anything that you want them to bring. Tell them. So they also, when they need ideas, they will go and visit these documents and read through. Okay, someone suggested that this standard is too old. Let's change it. A lot of people are giving the comments about it. So this is how they consult what the agenda. How we get it internally and what externally. That's good. Then after the agenda consultation, what do? Plan the work. So that's the plan of work. So it's part. So first they consult agenda and then they plan the work. So let's start from here. So they draw the issue. Okay. Now you will take the objective. You will take this part. So they will share it among themselves, the board. Now you are bringing this, and then the date, how the resources needed, all the other items, and then they will start the journey. How we get it? Good. Now, after the agenda consultation and plan of work, whatever be the conclusion, you have to put the conclusion in what? Paper form, and we call it what? Discussion paper. So that's the step two. Discussion what? Paper. So discussion paper. Discussion paper. Now this discussion paper, I normally call it what? The skeleton version of the standard. Skeleton. The point, the main issues. I'm going to talk about it. Okay. The main issue. Now, standard like PPE, what are the main issues? Okay, initial measurement, definition. Okay, we should define them. We should inclusion, example, objective, scope, recognition, measurement, disclosure. We are done. So these are 5 issues. So objective, scope, recognition, measurement, disclosure. We are done. So these are the main issues we're going to talk about. So that's the word discussion paper. And then they bring it out. Now here it's a may. The word is what? May, not a must, not compulsory. So they may send it to the general public for review or for comments. They can also keep it to themselves. It's a may. Good. According to their constitution, it's a may. So that is it. And the third step, or from the discussion paper, after they put the main issue, so that means it's the main issue they're going to talk about it. They're going to what? Expand it. And they form a standard. Now, after this, we form a standard then. Yes, we form a standard after this, our own standard. Don't worry. Now, from here, they have to now draft the standard itself. So we call it what? The exposure draft. So from discussion before you go to where? Exposure what? Draft. Exposure draft. So that's a draft version of the financial reporting standard, of the standard. So that's the draft. So after the skeleton, now they've added what? Elective first to it. Yes, they've added to it. Now it's becoming complete. So that's the exposure draft. Now this exposure draft, here, it's a must. That one then must. They have to send to general public for comment. Because if I don't see the first, I have to see any impact though. And that case not take you'll be there and then they just put anything together and just that we should start using it too. So you have to see it. You have to know that like this thing, a lot of people are going to use it internationally, many countries. So let them see what they're going to use. Fairness. So the final stage they must, that one is a must. But here, if they don't see it, at least the final stage is a must. You have to send what the exposure draft to the general public for comment. For comment. So this must be sent to us following the discussion paper or comment received from the discussion paper. Exposure draft will be prepared and this will be sent to who? The general public for what? For comment. How do you get it? Good. Then the fourth stage. What if the comment wasn't nice? What do you do? So that means you have to revise it to amendment. Good. So the revision of what? Exposure draft. Revision of what? Exposure draft. No substantive. So that what? Revise what? The exposure draft. So, and they are going to revise until the final one is being what? Accepted. You know, the board is made up of members, and the members have to vote on it before they will accept or before they will publish this any standard. So, in fact, internally, the board can even majority cannot pass or cast their vote on the publication of the standard. So basically, that always should tell you that that's why IFRS 9 they are not done with it. So it's in revision. They've been revising until the final one will be accepted and they'll publish it. So that is it. Now, what do you think will happen after the final one has been accepted? That's newborn baby, eh? Good. So the first one will be what? New IFRS is what is issued. So issue of what? New IFRS. So issue of new IFRS. Okay, so newborn baby. That's it. What do you think will happen after the issue of the IFRS? After the issue, when they issue the IFRS, what do you think will happen? After the issue of the IFRS, what do you think will happen after the issue of the IFRS? General public will adopt. I like that. General public. I like the adoption. So adoption of what? New IFRS. That's the next step. Adoption of what? New IFRS. At the issue stage, that's where they publish they will gazette it and then internationally. And then the adoption stage. The sixth version or the sixth step is what? Adoption of what? New IFRS. Adoption of new IFRS. That is the sixth one. Adoption of new IFRS. So adoption of new IFRS. Of course, if they issue someone else wants to adopt, that's it. What about the next stage after adoption? What do you think? We don't go and sleep. Those who prepare the standard after people have done, will they go and sleep? What they will do? Tell me. Mhm. After they've issued it, people have adopted it. When they are done with their job, or they are not done, they shouldn't rest at all. Why? You have to see whether they are using it well, right? Whether the requirement, yes, post implementation review. Whether the requirement has been adhered to, no versions, no remix of the standards, no self versions like alternative will be. So the next step is what? Post implementation review. Post what? Implementation review. You have to review and see whether the requirements stipulated are being what followed by companies. So here, that's the work of what the interpretation committee. You have to go around and see whether the actual requirements or the actual issues are the one that the companies are dealing with. They are not having their own massaging the requirements. So if you go and then they are massaging the requirements, what do? You tell them, you explain them the actual requirements, and then you are done. So over here, let me even chip in one item. The disadvantage of international harmonization, one of them is that lack of strong accountancy body. So any country that does not have a strong accountancy body, such country will not go for IFRS. But they know that there are people, when they go for it, they will do remits of it. Nobody will enforce it. Even ICA, Ghana, thank God that we have ICA. The ICA will enforce the IFRS. We still, people are using it. Yes, so that is it. Now, this new process, it came in October 2018 for 10 months. The new process. And the qualitative features also came for 10 months that year, making 20 months. I don't know when, I don't know the next time that the good news will pop up like that. But anytime there's a good news, then it comes from what you've done. The barriers and what the importance of the harmonization. And then coming from the conceptual framework up to what we've done. So we can be asked to come out with it. So on that note, we have successfully finished what the conceptual and regulative framework. What left is the legal framework, and that one is in your hands. You've done law. So we don't normally do it here, and you'll be fine. The specific banking laws, we are going to calculate financial report. But this is what a calculation paper we are going to report. Okay. Now let's go through few questions. Aside the two specific questions being asked in October 2018 for your paper, yes, I've given you some few questions that You can practice them and then you'll be fine. So let's go to the questions and see. So if you have your handout here, you can also open with me and we see the question. Okay, let me um, go through them with you. But before that, if you do have any question, kindly ask before we start the question sum. So first chapter. So question one, page 22, right? In fact, some of the question I'll go straight to the technical questions. So page 22, are you? Okay, the questions are in. Good. So question one, okay. Let's see if we can do just question one. Question one is a textbook question. Textbook questions. It's not a textbook question. Now let's see. Explain the difference between what the conceptual and the regulatory what framework of financial reporting. So what's the difference between the conceptual framework, or they are the same, there's no difference, or they are the same? Conceptual and regulatory framework. Any idea, friends online? This is the question solving stage, and this is the interactive section. Good. So tell me the difference between the conceptual and regulatory framework. Now the difference is that with the conceptual framework, it just tells us the principles, the concept, the limit, the functions of what financial reporting, the objective. Just give us the basic principles that form the basis of what financial reporting. That's the conceptual framework. What about regulatory framework? Also talks about what rules and other what regulations that form or that govern financial reporting. You can give example of the conceptual framework. What it talks about? It talks about objective. It talks about the qualitative characteristics. It talks about the assumptions. And the regulatory framework also talks about the IFRS, the laws, local laws, and the other directives. We are done. Okay. So have you seen how you answer such a question? Good. Now two or B, define and discuss the fundamental and enhancing qualitative characteristics of financial statement or accounting information. This was the October question. So your October question came for 10 marks. He just said that, or he stated, discuss, he just said discuss the characteristics of accounting information, the qualitative characteristics, that's all. He didn't separate them for 10 marks. So what are the qualitative characteristics? We said that there are what two types of the qualitative characteristics. They are fundamental and what? They are missing no. Paper jam. Paper jam. The paper is jam. Last week, oh, and the paper is jamming. And in general, there, fundamental qualitative characteristics. I like that. I think someone good, fundamental, in fact, and good. I like your answer. Yes, fundamental and what? And then enhancing qualitative feature. There are two. So let's talk about the fundamental. What are they? What is fundamental qualitative characteristics? So they are fundamental. Any financial statement that so any qualities that make the financial statement what useful, they are all fundamental. So any quality that make the financial statement useful is what fundamental. And those qualities are only two. What are they? Faithful presentation, and like that, and what? And relevance. Wow. That means the financial statement that we are going to prepare, it must be faithfully represented. Have you seen? And it must also be relevant to the decision made of the user. Uh-huh. Not that you prepare the financial statement and so they are calling you for another information. That's what I provide to you, but they're still calling you that no, I want the other one. Meaning, what they have is what irrelevant. So anytime you present something to your boss or your subordinate brings something and say no, go and bring the other one. You send your children go and bring something to you. Go and bring this item. They go and bring different items. So no, the other one. They go and bring different items. Why are you sacking them? Because what they brought first is what is irrelevant, right? Good. Now, what do you say about faithful representation? Recap. Faithful representation. It means that the financial statement or the information that we are presenting, it must also represent the actual or the true substance of the entity, or it must represent the economic reality of the entity. That's great. Now, you say you cannot define faithful representation without some four key ingredients. What are they? To report faithfully transactions, the financial statement must be what? 1. Complete. 2. Neutral or unbiased. 3. Free from all material errors. And then finally, it must be represented on the substance, but not what? The form. That's it. Good. Then you go to relevance. Relevance, as you said, it must be able to provide the decision needs of the user. That's the relevant. It must be able to provide what the user needs to make its decision. So if you're going to send information to the shareholders or the other stakeholders, make sure that you send information that will help them to make a good decision or will help them to make any decision that they want to take. Don't limit them. Don't hide things to limit them. Good. That is it. And we talk about maturity. Now you can go to enhancing. Enhancing are four. What are they? The four enhancing qualitative features. Four enhancing qualitative features. They are 1. Comparability. The financial must be compared to the other entities or our own by different years. That's good. And to enable comparability, there must be what? Consistency or what? Disclosure. Good. Then you can also talk about what? Understandability. Yes, if an accountant not pay financial statement, nobody understands it. Trouble. The same way in exams, the answers are going to provide, they don't must understand it too. And sometimes, we understand examination pressure. Examination pressure can cause, I'm not mentioning it, the cancer one is not cancer. Yes. Let's continue. So that is the understandability. The financial statement that they are preparing, they must understand it, right?
Yeah.
The same way your answers to the examiner must understand it, make decisions out of it, and interpret it. If the examiner does not understand your answers, then so that is it. Now the last one or the last pattern is what? The verifiability. The financial information must be able to what? Verify by what? A third party, usually what? The auditors, external auditors to decide. So the same way exams, your financial statement or your financial statement exams, your answer booklet or the answer you're going to produce. Also be what? Verify. Good. And then lastly, timeliness. It must be what? Be on time. Not too late, not too early. Because if you provide information too early, it will be devoid of its purpose. Too early, become relevant. Too late, you don't like it. So on time, yes, on time. Just that, this one I don't want to comment. Because the financial statement that we prepare, tell me, 2020 financial, it's not even ready, they don't prepare it. 2019, the latest one is 2019, right? Which was ready when? March. No, 2019 ended December. Now, for the government sector, I don't want to even go there. For public sector, don't even go there. I can show you that some of the public sector entities, their latest financial statement is 2014, latest 2015 financial statement. So such financial statement will be void of its what purpose. So timeliness, it must be on time. The financial statement prepared must be on time. So that is it. And then you find good. Let me try this. Now the next question says that C. Assess the advantages. No, C. I not do C. C is the measurement basis. I did not treated, so I move on to D. D. Explain the ISB standard setting process, so-called the due process. That was the October 2018 past question. The standard setting, yeah, the last one. So that is it. So standard setting, that was the last one we did. So that one, remember it, right? Then we can move on. Please, I hope you know the closing time is 9, right? Okay. Yes. I hope you know that it's 9. Good. People have started dozing off already. Yes. Now, the E is saying that outline and discuss the advantages and disadvantages of the international harmonization of financial reporting standards, right? That's the next in command. So, if they have examined the qualitative features and they've examined due process, and then have you seen how I'm doing it? And the next one is what? Uh-huh. Yeah. These are the topical issues stipulated in the conceptual and regulative framework of financial reporting. The main issue. Good. So the advantages so that comparability, transfer of staff, reduce audit costs, and those stuff, I will get it. So these ones are not issue. All of the solutions are in the handouts, and then we discuss them today, so you'll be fine. Now question 2. If I do question 2, you do question 3. If I, okay, 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 let's see. Now question 2. No, in financial reporting, Fred is saying that the requirement first. So I'll go to requirement. The requirement required. Prepare brief note for the finance director addressing each of the following and using the ISB framework as a source of reference. Which of the framework? The conceptual framework as what source of reference. Uh-huh. So first, A. Identify potential providers of what finance for target what fruit limited and their what information requirement in respect of financial statement. What are they asking for? Users and the information need. We did that one. We did under the objective of what financial statement to provide information to the users. So it helps us to analyze the users. But here you are limited to only a particular user or a particular users. That's the loan providers or providers of finance. So not any other user. So if you go and mention customer, go and mention employee, even though they are users, but they don't fit here, they don't provide finance. So one, what are they? Who? The provider of finance. One, lenders or bank or loan creditors. Two, suppliers. Three, shareholders or debenture holders. All of these are what providers of finance. And you tell them their information need. So bankers or lenders, what they need? They want to know whether you can pay their loan on time or you can keep within the interest. Yes. Some company when a big loan from me, they finish paying the principal, the interest in pan J, lie. They'll change their name right now. Interest, bad it. So that is it. Shareholders or the owners, they also provide funds to the entity. What will be the information need? One, they're interested in profitability. And then two, their return. How much are they getting on their investment? That's a dividend. And then lastly, they also check the expansion programs or the viability of the entity. And then you are fine. Good. So this is how you go to answer this question. Now let's do the B. Explain the term performance. Wow. And position. How do you explain performance? Performance and what position? And identify which of the financial statement will assist the user in evaluating performance and position. So which of the financial statement? So any help? Which of the financial statement? Friends online. Good. Profit or loss will determine your performance. So we use profit and loss to assess what? Performance. Good. What about the financial position? Now, we say we should define performance first. What is performance? Performance simple means your profit or loss for the period. We assess your profitability in terms of profit or loss for a particular period. That's your performance. Yeah. But normally performance be measured in terms of what profit or loss that we made. Even though in reality it's go beyond profit or loss. Sometimes performance include what? Long survival. Someone can make some small or average profit, but that person can survive for long term. But someone can come and make billions of money within 2 years and then vanish from the town. But you know them, right? You know, men's good, right? Exactly. So performance sometimes go beyond your profit that you are making or the returns that you are making. Sometimes go beyond that and then talks about your survival. Good. What about position? Position talks about what? Assets and what? Liabilities. Position is not your market position. It's what? Your assets and liability that you have. So now we use financial position to assess that. And then C, indicate why for decision making purpose alone. Indicate why for decision making purpose the financial statement alone are what? Insufficient. Wow, I like this question. Yeah, indirectly we are just asking the limitations of what? Financial statements. That is the for decision making purpose alone, the financial statement is what? Insufficient. Why are we saying that? Why? So tell us why for decision making purpose financial statements are insufficient. Mhm. One, the financial statements are what? Recorded item. It's based on historical figures. The thing will occur before we record, right? It failed to predict the future. So because it's based on the recorded figures, we don't normally use what predict, and decisions are made into the future. You're making decisions for tomorrow. So we need event that what might occur tomorrow to make the analysis. But if you based on financial statement, it has already occurred. Good. And then the major issue is that the financial statement, as the name suggests, financial statement, it failed to consider what or include non-financial aspect of the organization. And trust me, if any company or if you're making any decision, the non-financial aspect are critical normally than the financial. Why? Now the non-financial form about 80% of the company's operation, but the financial one is just 20%. Now the issue is this. Examples of non-financial, they are the product quality, customer loyalty, customer service, customer satisfaction. All of this will not be captured on the financial statement. Why? Because you cannot express them in monetary terms. Meanwhile, if your product is not quality and the customer is not satisfied, will you get the money? Exactly. If employees are not motivated and then they are not giving out their good or their possible, like we're giving out the best output, we get your profit, not at all. So if you're making decision and you throw this aspect away, you thought like the one financial statement that you have can let you do all the decisions, then you're deceiving yourself. In fact, I normally say that if you want to like survive for long term, forget about the financial and work on the non-financial. All the financial depend on what? The non-financial. To sell and get good money depend on product quality, and then to get product quality depend on your employees. Yes, because some of them are giving their possible best, doing well. Other people also are like because self-pay, right?
Yeah.
Exactly. So it's very important. So as a result of this, and sometimes too, the financial statements are subjective. For most of the items in the financial statement are what? Are estimates. So if I give you the chance to do the estimate different figure, which will estimate different figure based on what my judgment and assumptions. So for decision making, exactly, exactly, exactly. So that's it. Good. So that's how we do to solve this question. Now, have you seen that we've solved the question that we did just now, right?
Yeah.
Exactly. That's how we solve our questions. So now let's now given to you are not other important, except few ones. According to my analysis, most of the first questions that we normally ask after a case study does not depend on the case. So you can normally get those one correct. Yeah. Except for where there are figures or where there are analytics. Uh-huh. You have to relate to the case. But here, no issue or no figures or no analysis. So that is it. But you can read them once you have time. The actual solution is what we provided. Now question three. This. Question three is your homework. Yeah, question three is your homework. I like the question. I will explain. I will explain. So let's go to the requirement first. It's saying that first define the term assets and liability and recognized. A. So define recognized. Wow. How do you define recognized? Recognized. Recorded. Okay, good. So assets can define assets. So we can define liability too. Good. Now B. Prepare brief notes for Carl Roberts discussing whether the above result in an asset or a liability, and whether or not they should be recognized in the financial statements. Note, you are not required to refer to a specific IFRS, no standard that may be relevant. No, use ISB framework, the conceptual from no standard. We've not done any standard so far, right? So no standard. You're using what? Just what you've done so far. Good. Now let's go to the scenario. So question like this, we need a scenario. Obviously the first one, we don't need a scenario. B, we need a scenario. So now let's go to the scenario. We have to link it. So it's saying that Dave's and what? Says Limited, that's DNS. It's a well-known publisher of what? Children's educational books. The finance director, wow, Karen Roberts, is known for her commercial acumen rather than her technical ability. Meaning technically, not. She is therefore seeking your advice. Yes, you know that you are a qualified bank or accountant, you've done accounting. Seeking your advice on two particular accounting issues. One, value of head of what? Publishing. Value of what? Head of publishing. Now let's see. The company have recently appointed a new head of what? Publishing. Jane, let me say. Jane recently worked for a key competitor, that's S and H PLC. Jane is extremely popular amongst the leading authors in the market. Even in Ghana, Gaute, Okuba and then Kwesi Pladina, right? Yes.
Yeah.
So if you get Kokuba and Kwesi Junior in among your editing team, come on, like you make a headway. Good. And is sure to attract the service of certain authors currently working for the the company. Carol believes that Jane is therefore what of great value. The guy is great. Great value to the company, and that such value should therefore be recognized in the balance sheet in the form of what? How do you get a question? That's very good, oh. Yes.
Interesting.
So you tell the Can Robert whether Jane should be recorded as what? Asset on the balance sheet. This one I need the answer. You're going to solve it for me. How do you get it? Yes. So how to know how we start from?
Yeah.
Good. So this one you do it. And let's go to the item number 2, provision for alleged breach of what? Copyright. Good. I like that. Now, the issue is this. Carl is aware that Poppy Anderson, that's one of the DNS Limited authors, is being accused of including ideas in her text that have been previously been published. Stealing people's ideas. Oh. Okay. Carl is certain a legal case will ensue, and therefore, being prudent, wishes to recognize what? A liability in what? In account now for any what damage that are likely to what arise. So can she go ahead and do that? So he explained. So we tell Carol that before you can record liability, two conditions must be there. Have they certified the condition? That's all. Have you get it? So this is how I want the answer. Please, I'll pick everybody's answer. Make sure that, in fact, it will take 48 hours. So within 48 hours, it must be submitted. And then I'll go to before our next meeting. Because before our next meeting, we will do the film item. If you have any question, kindly ask before we continue with the question solving. Question solving. I will get it. Please make sure that you go through all the questions. So, especially question 1 and 2 and 3. You'll be fine. Oh. Yes. Fine. Then question 4 is saying outline the rule and the structure of what the International Accounting Standard Board. So what are the rules, the functions of what the board, and what is the structure of the board? That is it. So the functions of the board, they are what are the functions of the board? That's the first thing I have to look out for. Functions of the board, they have 3 functions. You mentioned them, right? The main one or the sole function is to what? Prepare and what? Issue IFRSs. Prepare and issue IFRSs. That's the main function. Prepare and issue IFRSs. Second function, they bring what? The conceptual framework what? And then the second, they have to report back to the IFRS foundation. Good. The IFRS foundation. That's perfect. Good. So now you'll be fine. Good. You'll be fine. So and then the structure. What's the structure of the ISB? The structure that we look at is made up of what? The advisory board, the advisory council, the patient committee, and then what the top, that's IFRS foundation. And then you are fine. Good. So in fact, you will continue the question solving, even though I will end here. But question 5 is yours. So, it's one of the what I'm looking for. One of the question I'm looking for. Question 5. Yes, you'll add question 5 to it for me and then you'll be fine. So there are two questions, right? Question 3 and what? Question 5. 48 hours each. 48 hours. Good. All what you have to do is you can write it down. No typing. No typing. You write it, take a picture of it and put it. Yes, no type. Good. Because there is something no type. Yes. Exams no type. Because if I say type, it may end up no copying from the internet for me. Oh. So that is it. Good. Now I like the question 5. Question 5. Or the question 5. Because it talks about substance over form there. And then you'll be fine. Okay, so that is the end of the conceptual and regulative framework. Let me explain the next topic to you. The next topic we're going to tackle the main issue. We're going to prepare the financial statements. We are going to do preparation and presentation of what? Financial statement, the P&L and the balance sheet. We're going to learn how to prepare the financial statement. So I'll give an assignment there, but that one will not take 48 hours. That one will take more than 72 hours. That one, it's a format that before we meet next week, familiar yourself with that format. From head to toe, it's a format. Even though I will explain it, that format again next week. But if you familiar yourself with the format alone, you'll be fine. So that is it. So I'll project the format for you and then you familiar yourself with it for me. And then you'll be what? Fine. You'll be fine. So I think I call it format. Where is it? Maybe okay, good, good. I will forward you the material, the next material. So after today, I'll forward you the next material, the preparation and presentation of the financial statements. Now, this is the format that I want you to go through. Okay, you don't have it, so I'll forward it to you. Good. The format starting from revenue. Now you know what a revenue is, cost of sales. Even though when we come, I'll explain it further how we arrive at this item. So kindly familiar yourself with the format for me. There are three in number. So change in equity to its parts, and then finally the financial position, and then that's all. So that's the our next section. Please, the next section from next section going, they are the topical issue. So that one, glue yourself to your device and get every aspect. No distraction, no sleeping, no dozing off, no flipping off, and no chatting. Good. So that is it.